Do you guys remember the Evergrande crisis?
Things are not going to plan with China's economy.
Collapse of the world's most
Whatever has
indebted
gone wrong.
property developer.
Now another developer named Country Garden is collapsing. Country Garden is 4 times bigger than Evergrande. So yeah, things are about to get much worse for the CCP. China's debt crisis may be the end of Xi Jinping. I'm not just saying that. This is something we can see happening in Chinese history over and over again. Every time a Chinese empire has collapsed, it's been because they were over-leveraged. Now, Xi Jinping's CCP is falling into the same cycle where the government and the economy is insanely over-leveraged. While this system of hiding debt and thinking about it later may have worked in the past, the same formula just doesn't work anymore. Left unaddressed, both on a national and international level, what we have now is complete and utter chaos. So, to better understand how China got here, let's start with a brief overview of its historic growth performance. But first and foremost, please hit the like button below, as my videos exposing the CCP always get downvoted by the CCP 50 Cent army. So your like helps us out a lot. Now, let's start. In 1978, China stood as one of the world's poorest nations. But there was a time before that when China was a global economic and technological leader in the pre-modern era, particularly during the Song dynasty around 1200. However, sometimes between 1500 and 1800, China began to lag behind Western Europe. This was well before the Industrial Revolution. The Great Divergence refers to the huge economic and technological disparities that emerged between the Western world and China in the 18th century. This period laid the foundation for the modern global order. During the Ming Dynasty, China was a global economic powerhouse. Its advances in agriculture, technology, and trade were far ahead of everyone else. The Ming Dynasty in particular was known for its naval expeditions, which reached as far as Africa. China was at the forefront of innovation, with inventions like gunpowder, paper currency, and the compass. The Qing dynasty continued this tradition of economic strength, but over time, various factors began to erode China's supremacy. China's rapid population growth led to diminishing returns in agriculture. The government's reliance on silver as the primary currency drained the country of its wealth. Furthermore, the Opium Wars and subsequent treaties in the mid-19th century weakened China's power and control over its own economy. The Opium Wars in particular played a big role here. They were fought between China and the British Empire in the mid-19th century and made a profound impact on China's history. These wars stemmed from Britain's desire to continue trading opium in China, despite the Chinese government's efforts to ban the drug. British military strength resulted in China's defeat in both wars. The Treaty of Nanking and the Treaty of Tianjin were signed under duress, forcing China to make significant concessions to foreign powers. These treaties imposed heavy financial penalties on China. They included reparations, indemnities, and the handing over of Hong Kong to Britain. The debt China accrued during this period was immense, draining the nation's finances. The consequences of this debt were multifaceted. First, it led to economic hardship for China, as a significant portion of its revenue was diverted to repay foreign powers. Secondly, these unequal treaties undermined China's sovereignty and further weakened the Qing dynasty's authority, contributing to domestic unrest. Meanwhile, Western powers like Britain and France were expanding their empires through colonization and trade. The Industrial Revolution gave them a significant technological edge. This period from 1850 to 1950 was marked by economic stagnation and decline in China. Despite the introduction of industrial technologies, continuous civil wars and disruption of World War II prevented substantial advances. As a result, China's per capita GDP actually declined during this period, underlying the magnitude of its economic challenges. A few decades later, the collapse of Qing dynasty in 1912 marked a pivotal moment in China's history. The country transitioned into a republic, aiming to bring about political and social reforms. However, the transition was ruined by political turmoil, as many warlords and factions fought for control across different regions of China. These warlords sought to finance their operation and maintain control, leading to a controversial financial instrument known as warlord bonds. These bonds were essentially promissory notes issued by warlords, often without the backing of any real assets. They were sold to raise money for warlord activities, further worsening China's debt situation. At the same time, China experienced rampant inflation because of factors like overprinting of banknotes and a lack of fiscal discipline. This high inflation devalued the Chinese currency, making it increasingly difficult to service the mounting debt. The consequences of China's debt crisis at the same time were severe. It led to economic instability, further social unrest, and hindered the republic's ability to implement meaningful change. On October 1st, 1949, the People's Republic of China was proclaimed under the leadership of Chinese Communist Party, with Mao Zedong as its chairman. Now, we did skip over a lot of history around how PRC took over, but that's because we have covered it a dozen times before, so I didn't want to bore you guys. The new government inherited a troubled economic landscape, including a legacy of debt from the previous government. CCP made significant changes in China's approach to debt, with a focus on nationalization of industries and repudiation of some foreign debt. So let's talk about CCP's policy of nationalization first. Key industries like banking, transportation, and heavy manufacturing were brought under state control. Nationalization was seen as a means to consolidate resources and ensure that state had a more direct control over the economy. The new government also made a bold move by just flat out refusing to pay some of the foreign debt incurred by the previous Chinese government. This action, particularly with regards to debt owed to Western powers, marked a significant change from past practices. This refusal was based on the argument that foreign debt was a result of unequal treaties and foreign exploitation. This era marked a turning point in China's economic philosophy. The government emphasized self-sufficiency and embarked on ambitious initiatives like the Great Leap Forward. The aim was to reduce reliance on foreign imports and technology and build a self-reliant industrial and agricultural base. The policy of nationalization and repudiation of foreign debt had a profound impact on China's economic and social landscape. The nation's economy saw a rapid transformation, although with mixed results. These changes set the stage for China's subsequent economic reforms and its emergence as a global economic powerhouse. In the late 20th century, China underwent a remarkable transformation under Deng Xiaoping's Reform and Open Up policy, which aimed to modernize China's economy by introducing market-oriented reforms and encouraging foreign investment. As China opened its door to foreign investment, multinational corporations flocked to the country seeking access to its huge labor force and emerging consumer market. However, alongside this economic boom, China faced a resurgence of domestic debt, particularly from state-owned enterprises, SOEs. These SOEs incurred massive liabilities as they expanded their operations. These debts were often the results of inefficiencies, overcapacity, and mismanagement within the SOEs. Managing the rapidly growing debt crisis became a significant challenge for the Chinese government. They implemented numerous strategies including debt restructuring, mergers, and privatization of some state-owned enterprises. These reforms also included measures such as debt-to-equity swaps, which allowed companies to convert debt into equity, reducing their financial burden. China also prioritized fiscal discipline and risk mitigation. The government implemented stricter financial regulations to control debt issuance and curb risky lending practices. China's economic diversification played a crucial role in overcoming debt challenges. The nation shifted from being solely a manufacturing powerhouse to fostering innovation and investing in technology-driven sectors. Additionally, China's active engagement in global trade and its focus on export-led growth helped generate revenue and reduce its reliance on debt for domestic growth. Infrastructure development became a cornerstone of China's economic strategy. Massive investments in infrastructure projects not only stimulated economy, but helped China project influence overseas through the Belt and Road Initiative. But later in the video, we'll explore how this initiative would come to haunt China's current debt crisis. China's willingness to attract foreign direct investment by opening up its market played a pivotal role. The nation created a conducive environment for FDI, further boosting its economic growth. The influx of foreign capital supported innovation and economic expansion. But during all this, the debt crisis never really went away. It just slowed down, but suddenly it became too big to manage. So now let's understand the current status of China's debt crisis. The causes of the debt crisis are complex, but they include key factors like state-led investment boom, shadow banking system meltdown, real estate market bubble, tax problems, export slowdown, and massive projects like Belt and Road Initiative. Let's go over each factors one by one. To understand this debt crisis, it's important to understand how GDP functions in China. For most of the world, the GDP growth is measured as a year-end output by statistical authorities, reflecting the change in economic activity from the previous year. But in China, the central government sets ambitious GDP targets for all the provinces at the beginning of each year. And typically, the CCP sets these targets quite high. So, how do local governments meet these growth targets without borrowing? In some cases, they resort to lying. Charlie Munger has a simple quote: "It's much easier to lie about doing a good job than actually doing a good job." So many times, governments just lie that they hit their target. Other times, local governments have resorted to acquiring unsustainable amounts of debt to finance extravagant yet financially unattainable infrastructure projects. These projects do help the local GDP figures, helping them reach their target, but they also generate unsustainable amount of debt burdens. A 2019 study revealed that officials from various regions had been inflating GDP figures and falsifying capital investment data. Why, you might ask? Well, in China, it's all about meeting those extraordinary economic growth targets. You see, local officials are rewarded for achieving these targets. But here's the catch. This often leads to overinflated reports of investment and overall economic activity. Now you might wonder, who's keeping an eye on all this? China's National Bureau of Statistics, or NBS, acknowledges that local reports tend to be overstated. However, they don't have the power to control the actions of local governments. Instead, they use the local government's data but adjust these numbers to arrive at the official number for the Chinese national GDP. These adjustments, on average, have amounted to approximately 5% of China's GDP since mid-2000s. A 2009 study discovered that the corrections made by the NBS to local government data were relatively accurate until 2008. But the corrections seemed too small after that and appeared to fall further behind over time. Meaning, after the Great Recession, when every country in the world was struggling, CCP decided to go along with its local government's lies to make things look better than they actually were. According to the same study, GDP growth from 2010 to 2016 was estimated to be 1.8 percentage points lower than the official numbers. And investment and savings rate in 2016 was 7 percentage points lower than the official numbers. To provide some cover for itself, the CCP even arrested officials for overstating local GDP figures. But lying isn't the only way these local governments hit their GDP targets. Sometimes local governments typically employ a workaround, something called a local government financing vehicle, aka LGFV. These LGFVs are special entities designed to facilitate off-the-book borrowing. This unconventional approach emerged in the 1990s as local governments sought to bypass borrowing restrictions imposed by the CCP. Over time, these entities became the go-to source for local governments to raise funds, resulting in loans through LGFV now accounting for a staggering 48% of China's GDP. What makes this debt particularly challenging is its hidden nature. As it remains off the books, the true extent of the problem remains unknown. This is how all this works. LGFV get the land for free from the local government. Then they either lease the land to developers or more often use it as a guarantee to borrow money from the banks. After that, they use the borrowed money to invest in expensive infrastructure projects. These investment spendings are then used to achieve GDP targets set by the CCP. Even though this sounds like a good idea, it's important to note that not all infrastructure projects are a wise investment. IMF data reveals that China's local government debt has nearly doubled in just 5 years to approximately $5 trillion. This figure doesn't even include LGFVs, which account for an additional $10 trillion or more. Unfortunately for CCP, this isn't the only debt problem on their hands. Moving on to the next factor, shadow banking system. First, let's understand the term shadow banking. That operates like a bank, but it's not a bank. These are non-banking financial companies, or NBFC, that offer banking services without holding a banking license. In recent months, there have been a number of shadow bank failures in China, including the Zhongrong International Trust. Shadow banks are financial institutions that operate outside of traditional banking system and are not subject to the same regulations. This makes them more risky, but also potentially more profitable. Shadow banks play an important role in the Chinese economy, providing financing to businesses and individuals that may have difficulty getting loans from traditional banks. However, they're also more exposed to financial shocks, such as a sudden decline in the stock market or a sharp increase in the interest rates. The failure of Zhongrong International Trust is a sign that the Chinese government is taking steps to reduce the risk posed by shadow banks. However, it is also a sign that Chinese economy facing financial challenges. The recent failures have raised concerns about the stability of Chinese financial system, but the Chinese government has stated that it is committed to maintaining financial stability and that it will take steps to support sound financial institutions. In China, shadow banking industry is estimated to be worth over $3 trillion. On top of that, this sector has deep ties to the real estate market, and that's where the things get worse. Now this brings us to our next topic, the real estate market bubble. Whether or not the Chinese real estate market has crashed is a matter of opinion. Some experts believe it has already crashed, while others believe that it is still in a state of decline. But there is no doubt that the Chinese real estate market is in trouble. Home prices have been falling for over a year, and many developers are facing financial difficulties. The situation became even more dire as we approached August, with data from National Bureau of Statistics indicating that a staggering 7 billion square feet of unsold homes in China. To put this into perspective, that's roughly equivalent to 7.2 million homes. A former official revealed that the current number of empty homes in China is enough for 3 billion people. That's more than double that of China's current population of 1.4 billion people. This makes you wonder, why did China build so many houses? To understand the Chinese obsession with real estate, we must first understand their culture. For centuries, owning land has been considered a symbol of social status and stability. Chinese families often view real estate as a means of passing down wealth to future generations. It's not just about securing their own financial future, but ensuring prosperity for their children and grandchildren. Real estate is a huge part of the Chinese economy. It accounts for 29% of the GDP, and about 70% of Chinese people have their wealth invested in a property. During the early 20th century, China's economic growth had been nothing short of phenomenal. With a rapidly expanding middle class, the demand for housing had skyrocketed. This surge in demand had pushed real estate prices higher and higher. The Chinese government also played a significant role in promoting real estate investment. Policies such as low interest rate, favorable tax incentives, and easy access to mortgages had encouraged citizens to invest in property. So, how did this crash start? Between 2020 and 2022, China's property market witnessed a dramatic downturn. Sprawling complexes turned into ghost towns, residents organized mortgage boycotts, and a global pandemic worsened the situation. At the center of this crisis was Evergrande, China's second-largest developer. Evergrande's founder, Hu Kai-in, was once the second richest person in Asia. However, in 2021, his wealth plummeted by a staggering $17.2 billion. Since 2017, he has lost over 90% of his personal fortune. The crisis also affected countless homebuyers, many of whom are trapped in half-finished properties. Some have even moved in out of desperation, while others struggle to pay both mortgages and rent. Attempts to communicate with Evergrande often led to dead ends, and organized protests were halted, and homeowners faced intimidation. But how did China's housing market go from boom to bust? To understand, we must first look at China's unique resale market. Unlike other countries, where home buyers pay a down payment and not the full amount upfront, in mainland China, the full cost is required upfront through a combination of down payment and bank loans. This puts Chinese buyers at unusual risk. In Hong Kong, for example, the down payment is supervised by third parties like law firms. In China, on the other hand, the money goes directly to developers' bank account, which they end up using to lease more land instead of construction. This is what led to the infamous rotten tail buildings. The root of the issue can be traced back to 1990s, when China's urbanization began. The surge in demand for housing was met with the introduction of the pre-sale housing system in 1994. Evergrande was established in 1996, perfectly positioned to capitalize on China's rapid urban development. Over the years, Evergrande expanded rapidly, earning billions in revenue. However, the COVID-19 pandemic triggered a financial crisis. In 2021, Evergrande defaulted on major bond debts, leading to Chairman Wang's resignation. Evergrande is the second largest developer, and it caused so much havoc. Imagine what would happen if this happened to the largest developer, Country Garden. Last month, Country Garden narrowly avoided default by making last-minute interest payments on its bonds. However, the country reported a staggering $7 billion loss in the first half of this year, symbolizing the crisis gripping China's real estate sector. A default by Country Garden would be a huge red flag, potentially triggering a collapse of the entire Chinese real estate market. Country Garden was once seen as the leader in the sector, and its troubles could signify a larger financial storm on the horizon. It could also have a domino effect on other developers and the entire economy. Despite government's measures to cool the market, buying homes in China remains unaffordable. Empty homes and incomplete buildings in Shanghai reflect the struggles of the property builders who have run out of cash. But who's to blame for this crisis? Experts argue that while the Three Red Lines policy aimed at curbing debt could have worked, it was introduced at an inopportune time. The sudden halt in China's housing market was a black swan event no one anticipated. This real estate crisis will have long-lasting consequences on China's economy for years to come. Now, let's move on to the next critical issue: tax problems. There are a few significant tax-related challenges in China that are worth talking about. China's tax dilemma is essentially threefold. First, they struggle to collect taxes from most of their citizens. Second, the wealthy individuals and businesses in China have mastered the art of tax avoidance. Lastly, even the taxes they do collect don't always find their way to where they are needed the most. Let's break it down one by one. The Chinese government's monumental task is overseeing 1.4 billion people in a vast and diverse country. To manage this, they have delegated authority to provinces and sub-provincial regions. These local authorities have their own funding needs, primarily met through taxing businesses and leasing land. China has a progressive income tax system, but most people in the informal economy avoid paying their fair share. But the elephant in the room is the tax loopholes. Like many nations, China faces challenges in closing these gaps. Tax evasion has far-reaching consequences. When individuals and businesses evade taxes, it directly affects the government's revenue collection. This shortfall can lead to increased debt for the nation. China, like any other country, relies on tax revenue to fund essential services, infrastructure, and social programs. These challenges are causing severe implications for China's fiscal health and are contributing to the growing debt burdens. On top of this, China's golden goose, the export sector, is also slowing down. As most of you already know, China is the world's largest exporter, and its export sector is a key driver of its economy. However, in recent months, China's exports have been slowing down, and the country is now facing deflation. Recent trade figures for July revealed a decline in both exports and imports, further amplifying concerns. There are a number of factors that have contributed to this slowdown. One is the global economic slowdown. As demand for goods and services weakens around the world, China's exports are suffering. Another factor is the ongoing trade war between China and the United States. The tariffs that have been imposed on goods traded between the two countries have made Chinese exports more expensive and less competitive. In addition, China's domestic economy has been slowing in recent years. This has led to a decline in demand for Chinese goods from Chinese consumers. As a result, Chinese manufacturers have been forced to cut prices in order to sell their products. The combination of these factors has led to deflation in China. Think of deflation as opposite of inflation. Inflation is when prices for things like goods and services go up over time. Deflation, on the other hand, is when those prices actually start to decrease. Now, while this might initially make you feel like your money can buy more, it's important to realize that deflation is not a positive sign for a country like China. When prices fall too much and too quickly, it leads to a chain reaction of problems. Businesses struggle to sell their products because people start waiting for even lower prices. As a result, businesses earn less money and might even need to cut jobs to stay afloat. This in turn leads to fewer people spending money, which eventually slows down the economy. The Consumer Price Index, aka CPI, gives us a sneak peek into how consumer goods are priced. It's like a thermometer for inflation. The recent news from China is that CPI has fallen by 0.3% year-on-year, while the Producer Price Index, PPI, fell for 10th consecutive month, down 4.4%, a sharper decrease than anticipated. In more simpler terms, stuff like food, clothing, and transportation is becoming cheaper. Now, this may sound like a bargain, but it's actually a red flag for the Chinese economy. Here's the domino effect. Falling demand means factories produce less, and that's where things start to get problematic. Fewer goods produced means fewer jobs created. Layoffs become all too common, and investments start to dwindle down. It's the snowball effect that leads to economic stagnation. People are afraid that China may experience a long period of slow economic growth, similar to what happened in Japan's lost decades. You might wonder, how did China get here? This wasn't an overnight tumble. Earlier this year, China set a goal to keep inflation at 3%. But alas, that's not what happened. Inflation plummeted into negative territory. To counter this, government tried everything from stimulus packages to slashing interest rates. But it was a bit too late. And here's where the things take a crazy turn. Chinese officials seem to have gone silent. Meetings are being declined, communications curtailed, and opinions are being suppressed. Why? Well, a new anti-espionage law looms over them. This law was launched in June, which places a mask of secrecy over every move. It's like the officials have been sent back to school with mandatory training on how to keep a secret. But what are the consequences of this newfound silence? For starters, foreign direct investment has hit a 25-year low. Meanwhile, Goldman Sachs made a big report about 12 Chinese banks that are on the Chinese stock market. The report underscored China's rising local government debt and credit portfolio losses. Goldman Sachs also estimated that China's local government debt has surged staggering 11.14 times between 2008 to 2022. Now, that's huge. The global market's mistrust of China's policies and the CCP's erratic behavior has led to a decline in foreign investments. Speaking of mistrust, many countries have already rejected or abandoned China's Belt and Road Initiative, and many other countries have expressed concerns about the BRI, such as high cost of projects, lack of transparency, and potential for debt trap. Now, as many of you already know, BRI is a big and complicated topic. That's why we have a whole video dedicated to this one topic that's coming up next. Lastly, I wanted to give an explanation as to why the original voice is away from the channel. It has to do with health reasons. Because of some issue with his throat, every time Jack recorded a voiceover, he was experiencing pain. As our videos became longer and longer, it became harder and harder to record. Unfortunately, the issue is still not properly diagnosed, so he has taken a pause from recording. That's why we started trying out different freelance voiceover artists. But one issue we ran into is that a lot of freelancers we work with were not really interested in geopolitics. And you could tell that when listening to the voiceover and the video. There would be obvious mistakes like mispronunciations and stuff like that, which of course is really frustrating when you're watching the video. So another route we went with is now we are having people who already work with us record voiceovers. Since we know people who are working on the channel are already interested in geopolitics, and hopefully that translates into the voiceovers. Everything else with the channel is still the same, and we just wanted to explain the voice situation to you guys.